$1 million every day, would you still need more than 2,000 years to spend $1 trillion? And Americans currently own about 1.26 in 26 trillion on credit cards. Think about that for a second. That's a 1.26 trillion. uh, That's 1.26 trill. That's 1.26 trillion sitting on little pieces of plastic that most people carry around their wallets. And here's what I found crazy. We are constantly told that credit cards are good. They help you build credits. They give you cashbacks. They give you airlines ticket miles. Some cards will literally pay you hundreds of dollars just to signing up. And how did this become a system where Americans are carrying over $1 trillion in debt? And before you say, well, people are just irresponsible, I don't think it is that simple if you guess. Because imagine you checking your account, hits zero on the 24th of the month. You still need groceries, you still need gas, your car breaks, your insurance payment is due, you have a medical bill you weren't expecting. What do? You could just say, sorry, I don't have the money. Or you pull out the credit card, and that's where the story starts. Because credit card isn't really dangerous when you use it as a payment tool. It's dangerous when it becomes a replacement for a income. And once that happens, the bank isn't just helping you spend money. You're borrowing money from the bank and potentially paying a ridiculous amount for the privilege. So today let's break down exactly how the $1.26 trillion card machine works, where the money comes from nearly, like why are bank willing to give you rewards, how $1,000 purchase can become a much bigger financial problem, and why this isn't just your problem. It's an American economic problem. But first we have to look at like why really American needs credit cards. Let's start with something I think gets completely misunderstood. When people hear credit card debt, they imagine somebody spending $8,000 on designer clothes and looking a luxury vacation they absolutely cannot afford. I'm sure that person may exist for that, but that's not only the way people get into debt. Sometimes it happens because normal life got expensive and you have rent or mortgage to pay, like you have groceries, you have utilities, you have a car payment, you have gas, you have insurance, you have subscriptions, and then something unexpected happens, like your transmission dies, your kid needs something, you have a medical expense, your paycheck comes a few days late, and now there's a problem. The money is gone, and but the bills aren't. So you put the expense on a credit card. One purchase isn't a disaster. That's the key. The problem is what happens when his becomes a pattern. Maybe it's like a $300 this month, or another $500 next month, another $700 after that. You aren't necessarily buying something outrageous. You are just slowly borrowing against your future income. And eventually you open the credit card statement and realize, wait, when did I own like $6,000? That's why it's more complicated than simply saying Americans are bad with money. Credit cards can become a bridge between income and expenses. The problem is that bridge has a toll, and the toll can be very expensive, brother. According to the figures we are working with, the average Americans carries thousands of dollars in credit card debt. It's some age group carrying nearly substantially more. And once you start carrying that balance, the bank has a very different relationship with you. Because now you're not just a customer, you are a borrower, and borrowers pay interest. And the chapter second is the minimum payment trap. Now let's say you own a 5 grand, you open a credit card statement, and you see like current balance is 5 grand, and underneath minimum payment is $125. And immediately your brain does something interesting. It stop thinking about $5,000. It start thinking about the $125. Oh, $125. I could have a credit card. Only $125. Yeah, I can handle that. It's only $125. And that's why the minimum payments are so powerful. Because technically, you're making the repair required payment. You aren't ignoring the bank. You are not sending them a big fat zero. You're paying. But you're not necessarily enough paying to make the debt disappear quickly. A portion of the payment goes toward interests, fees, depending on the card's details, terms. So let's say you send the bank $125. Maybe the balance barely moves. Then the next month comes around, you own more, then you pay again, and you start getting comfortable with the idea that I can afford this payment. It's only $125. But that's the wrong questions. The question isn't. The question isn't. Can I afford the minimum payment? The really question is, can I afford to eliminate the balance? They are two completely different things. And there's people can get stuck for years because a 5 grand balance sounds terrifying. But a $125 payment, that looks good. That feel like manageable. Yeah, I could manage $125. It's the difference between for the looking at the total problem and looking at the monthly symptom. This has become even more painful when we add interest on that. And chapter 3 is really talk about how $1,000 become a much bigger problem. Let's make the really this simple. Okay, you buy $1,000 laptop. Your credit card API is nearly 22%. You hear 22%, you might think, okay, the bank it's 22% at the end of the year. That's the thing. Yeah, that's not how credit card interest generally works. Many credit cards calculate interest using a daily credit rate and your average daily balance. In other words, the cost of carrying the debt is accumulated throughout the billing cycle according to the card's terms. And this is why the interest debt is so nasty. Let's say you have $1,000 balance, you make a small payment, but the interest doesn't disappear. You still have a remaining balance, and that remaining balance can keep generating more interest. So you're basically running on a treadmill and you keep making payment, but some of your money is being used simply to stand still. Now multiply by several purchases, the laptop, the car repair you have, like the groceries you got buy for the weekend, the flight you have taken, the emergencies. Suddenly you don't own bank $1,000 debt. You have a collection of balances, and that's when credit card become really dangerous. Not when you use it, when the balance become permanent, because now you're paying today's expenses with tomorrow's paycheck, and the bank is charging you for that privilege. I always thought like how the credit card business actually work and how actually it makes money really is like. eh, Now here's something people often miss. You might think banks make more money from credit cards only because customers pays interest. That's the way I thought, okay, and that's a huge part of business too. But it is not really the entire business if you look at like it's not the entire business. There's another source of revenue that happens every time you use the like card. Um, Interchange fees, like when you like tap your card and the payment magically happens in like 2 seconds. Yeah, behind the tap is an entirely new payment network, and the part of transaction fee can go up to like card issuing bank. And imagine you spend like $100, like a small amount, and you think, um, I spent $100, but the payment ecosystem can take a percent of the transaction before the money takes its way through the system. So the bank can potentially earn money from the card simply being used. And this creates a very interesting business model because the bank can make really more money from more spending of your card money and potentially from interest or revolving balances. So like if you pay your card like a full every single month, the bank can still earn money from your purchases. But if you carry a balance, now there's a potentially another revenue stream that leads to one of the most interesting question in the entire video. If banks can make money from people spending, why are they giving people rewards for spending even more? And I am always thinking like how bank give cashbacks. Think about like how ridiculously credit cards reward can get. Like a bank man really might can say like spend $4,000 and we will give you tens of thousand of points, or like you could see get like 2% cashback, or like here's a huge sign up bonus for like a credit card. But the question is why? Why would a bank willingly hand you hundreds of dollars because you're not the product. Your lifetime value is the product. Think about it, okay? Suppose the banks give you like a $500 sign up bonus. At first glance, that's really a $500 loss for them. Yeah. But now you are a customer. Maybe you spend $20,000 a year. Maybe you keep the card for 5 years. Maybe the bank earns interchange revenue from those purchases. Like maybe at some point you carry a balance. Maybe you get another financial products from the same company. Suddenly that $500 isn't necessarily a bad investment, I think. Yeah. It's a really a just in a simple term, it's a customer acquisition cost. And this is where the psychology gets really interesting. Cashbacks make spending feel cheaper. Points make spending feels productive. Airline miles make spending like feels like you're working towards something. Instead of really thinking like, do I really need this like $500 purchase? No. Your brain start thinking, but I'll get points for it. You haven't made the purchase cheaper. You just made it feel more rewarding. And that can really encourage more spendings. The credit card industry even has a famous term for people who pay their balances full. Deadbeats. Yeah, that's the term you use. It's really sound ridiculous, but the term reflects the economics of this. If you're a customer who spends heavily and pays everything off every month, the bank may earn transaction revenue from you, but you're not generating much interest income. The more liquidity customer can be you say like the revolver. Someone carries like a balance month after month, and that's where the rewards start making even really much like more sense. Someone gives like a 500 bonus today, you may potentially earn much more money on that from the overall relation letter. So the rewards aren't necessarily generosity; they are literally economics. And now we get to the part the debt can we start accelerating. Let's about debt. Let's talk about debt. Let's say something happens. You normally pay your card in full, but this month you can't. Maybe you had an emergency. Um, Maybe your income dropped. Something can happen. Maybe your expenses just exploded. Now you're carrying a balance. This matters because many credit cards have a great grace period on purchases when you pay the relevant balance in full. But once you are revolving a balance, the treatment of a new purchase can change depending on the terms of your card. And suddenly the card really feels different. Before like before, you're a swipe, you pay, you buy and fucking pay in a full. Now it's just like swipe, buy, carry a balance, pay, interest. And the scary part is how normal it feels. You still buy the same groceries, you still fill the car, you still buy the coffee, but now the purchases are happening inside an account. It's already charging you interest. How scam is this? Like, so the balance can start looking like this: $1,000, then $1,800, then $2,700, then $4,000. Not because you went crazy, but because the debt start becoming part of a normal cash flow. And that's why I call it the real debt snowball. You aren't using your credit to deal with one emergency anymore. You're using your credit to maintain your like lifestyle. At the point, the credit card isn't solving the problem. It's really is doing is just hiding the problem. And instantly people start looking for the way out. And that's where the balance transfers come in. Like now look at the next chapter, it's one card pays for another. Let's say you're carrying like $5,000 in a like credit card debt, and that's like an add up here. 0% APR balance transfer. And you think like finally a way out. And to be fair, a balance transfer can absolutely be useful when someone has a really plan to pay the debt down during the like promotional period. But here's what can be really wrong. Suppose you transfer $5,000 and the card charges 5% transfer fee. That's another $250. Like so like your new balance can start around 512 to 550. That's the thing. You might temporarily pay no interest. Great. But the promotional period ends and whatever remains get charged according to the card's particular APR and terms. Now there's another psychological problem. Your old credit card has a zero balance, and that empty bar can feel something available. So you have So you have literally a card which is really empty. A card B with $5,250. And the temptation is really obvious. You start spending on the card A again, and now the debt hasn't disappeared. It just moved. That's why I always think people should separate debt management from debt elimination. Moving a balance can lower the interest rate temporarily. It doesn't magically erase what you own. Like you still really own the money. Um, and eventually this whole system runs into a literal limit because debt can only grow for so long before somebody can make the payment, and that's when delinquency start becoming important. The New York Fed tracks credit card balance moving into serious delinquency, generally meaning 90 days or more past due. And when those numbers start rising, it tells us something. People are running out of room. Imagine someone is already carrying up $10,000 and they're paying the literally minimum, and they're relying on the cards for literally emergencies, and then something happens, their car breakdowns and they lose work for a few weeks, and they get hit with an unexpected like medical bill that could happen, and they don't have a literally savings, so they put the expense of the cards too, and now they're closer to the limits. Eventually the cards get maxed out, and then the credit score get damaged, and then getting another loan becomes harder, and the person, the fewer ways to deal with the original problem. Um, that's why serious delinquency matters. It it doesn't matter that every person with credit card debt is heading towards bankruptcy. It means some households are getting close enough to the edge that a simple financial stock can push them over it. And when that happens, nearly millions of households, this stops being just a personal finance problem. It becomes an really economic problem. Maybe you're sitting. Why this matters that even if you don't have a like credit card debt, really much. If you're sitting there thinking like, I don't carry a credit card debt, why should I care? Because the US economy depends heavily on consumers spending money. Uh, People buy groceries, going to restaurants, buying cars, booking vacations, buying electronics, paying for the services. Which household have to like spend more of the paycheck go toward old P debt? That money can also be used for like a new spending, and that's the problem. Imagine you suddenly having to spend like another $400 every month servicing debt. That $400 doesn't disappear. It just get redirected. Instead of restaurant, new car, savings, investment, or like home down payment you have, it got towards the old balance. Now multiply that across million of like household. That's why customer debt can matter to the business too. If consumer can slow down, business eventually feel it. If business see bigger demands, then can be responded by a calling, cutting spending, um, slowly hiring the things, reducing investments, and now this doesn't matter. Uh, $1.26 trillion of debt and automatic recession. That's way too simplistic. But it doesn't mean household balance sheet doesn't matter. Because an economy driven heavily by consumer spending worked better when consumers still have room to spend. And that's why this number is worth paying attention to. And the credit card machine, what do you can call anything you want. Like so let's put all this together. You start the consumer who has a rising expense. They use a credit card to fill the gap. The bank makes a purchase early. Rewards make spending little feel better. The customer keeps spending. Eventually, they carry like a balance, and interest starts accumulating. And minimum payment make the like debt feel manageable. Maybe they transfer the balance to another card. Maybe they open another card account, and now the debt become part of the normal monthly budget. Meanwhile, the bank can make money from the payment system, potentially from interest or like on revolving balance, or the system keep moving. And that's why I don't think the credit card and itself is really the enemy. A credit card can incredibly useful. You can build credits, you can earn a cashback, you can earn rewards, you can get like really fraud protections, you can make a purchase without like carrying cash. And the dangers start when the credit card stop being a payment tool. It becomes substitute for the income. Um, because once you're borrowing money to affect ordinary life, the MAT literally charges up $100 purchase might not longer cost $100. It becomes $100 plus the cost of carrying the balance. If you repeat that enough times, debt start controlling your future income, and that's what makes the 1.26 trillion dollar number so important. It's not just an enormous number on a fucking spreadsheet. It's a million of small decisions, uh, grocery bills, car repairs, medical expenses, a minimum payment, a balance transfer, another purchase, another month, and eventually all of this individual balance become a one giant number, $1.26. So this question isn't like, are credit card really bad? I don't know. That's so simple. The better question is, who is actually in the control of the credit cards? And are you using the bank's money temporarily and paying it back because it becomes much expensive? And is the bank quietly becoming part of how you afford your life? Because those are two very different things if you think. Once you understand that and you understand the credit card machine the government have, that's the real 1.26 trillion problem. And thanks for watching the video. Please do subscribe to the channel. I'm trying my best. I don't have a really good editor, but I am currently working to how good at it.